Like it or not, of recent, we all have noticed that there has been an increase in the price of one or more commodities we regularly buy. The price of gasoline is up, the price of food items is up, and even shelter and accommodation prices have risen. And the list can go on and on. Some items have even seen a price surge that surpasses 100%.
The current picture is plain to see. The labor market is extremely tight, and inflation is much too high.
Even though this episode doesn't seek to answer the causes of this hike in prices, which is referred to as inflation, it is worthy of note that inflation can exist as a result of much money chasing fewer goods, thus resulting in higher prices. An increase in money supply due to high government spending can cause this phenomenon. This was the case in America in 2021 with the big government stimulus policy. Over $1.9 trillion was poured into the economy as COVID-19 relief package. In our present context, the general increase in prices have largely been attributed to the surge in the demand of food and energy in the wake of the COVID-19 pandemic, a situation that has been exacerbated by the Russian invasion of Ukraine. Russia and Ukraine are quite significant in commodities, but due to the ongoing war, companies are less willing to purchase Russian oil. The war has also caused planting season in Ukraine to be limited. With all these, households are seeing the costs of their living skyrocket and the value of their money rapidly eroding. Though all these has portrayed inflation as the bad guy, inflation is an economic situation which can be leveraged to make some substantial gains. And here is how.
We at the Fed understand the hardship that high inflation is causing. We're strongly committed to bringing inflation back down, and we're moving expeditiously to do so. We have both the tools we need and the resolve that it will take to restore price stability on behalf of American families and businesses. The economy and the country have been through a lot over the past 2.5 years and have proved resilient. It is essential that we bring inflation down if we are to have a sustained period of strong labor market conditions that benefit all.
In 2020, the U.S. Federal Reserve set the year-over-year inflation rate target at 2%. That is why it is considered that above this rate inflation is dangerous. This is so because at this rate, inflation can drive too much economic growth and rob you off your hard-earned money. When prices of things you buy every day rise faster than wages, it would become even harder to invest and save, as lesser disposable income would become available to households. This is a situation that can have a counter effect on an economy's growth. People on a fixed income tend to suffer the more in such situations. When prices increase more than income, such persons lose ground and become poorer over time. A situation that can make inflation even super risky is when inflation causes an expectation that prices will keep rising. This fear of a continuous price hike will in turn worsen inflation as people will keep spending more now. Even though this can have a positive effect on economic growth in the short run, due to rise in demand that causes companies to produce more and demand for labor that also increases as a result, spiraling prices can lead to a currency's value. This was the case in Zimbabwe in the late 2000s with the drastic devaluation of the Zimbabwe dollar, which prompted the use of foreign currencies like the US dollar, euro, and South African rand as the country's official legal tenders. This is a phenomenon which economists refer to as hyperinflation. Inflation can theoretically help boost production in an economy that is not running to full capacity, meaning there is unused labor or resources. As mentioned earlier, when people expect prices to keep rising, they will be willing to spend more now. This will hence heighten aggregate demand. More demand in turn will trigger more production to meet this high demand. Inflation can also help prevent a situation where low prices can cause people to hold on their expenditure in the hope of getting a better deal in the future. Low prices mean less turnover and profits for businesses, and with less revenue comes a reduction in wages, employee layoffs, and a resulting fall in economic growth. Inflation is even more beneficial to debtors who repay their loans with money that is less valuable than the money they borrowed. Inflation is also beneficial since interest rates are calculated in part based on the inflation. So if there isn't any inflation, the Fed won't have much possibility to lower interest rates further. So, a moderate inflation level gives the Fed the maneuvering room it needs to try and jumpstart economic growth when the need arises. Despite the benefits that may result from inflation, to curb the sharp spike in prices in the US and prevent a situation of hyperinflation, the Fed on the 15th of June 2022 raised interest rates by 0.75, which is considered a record percentage point in the history of interest rate hikes by the US Federal Reserve since 1994.
Today, the Federal Open Market Committee raised its policy interest rate by 0.75 of a percentage point and anticipates that ongoing increases in that rate will be appropriate.
The interest rate in the US now stands at between 4.25 to 4.50%. And even though these higher borrowing costs can weigh down on the economy, the Fed hopes that this increased interest rate would make it more expensive to carry a credit card balance, get a mortgage, or a loan to buy a car, and thus tamping down consumer demand, which has overwhelmed supply and has caused prices to surge in the past months. Other central banks across the globe have also done the same.
What made you decide to go for 50 basis points instead of 25?
Well, we see at the moment that inflation is increased in Switzerland. We have close to 3%. And we also observe that we have a certain risk of second round effects. And we came to the conclusion that it's now better to increase interest rates by 50 basis points and not by 25 points in order to make an initial first step in order to really also signal that we are fighting inflation so that it will also over the medium term be in the range of price.
2009, and it's also the fifth successive meeting at which the MPC, the Monetary Policy Committee here at the Bank of England, has decided to raise interest rates. So put all of that together, and there's clearly one direction. It's worth saying, though, I'm just kind of scanning as the news comes through, because we'll also get the minutes on precisely which members have voted for what. It's worth saying, a lot of people thought there was a good chance that the bank might go even faster than that, raising rates by a full 0.5 percentage point.
Swiss National Bank on the 16th of June 2022 raised interest rates to minus 0.25% from minus 0.75%. On the same day, the Bank of England raised interest rates by 25 basis points to 1.25%. Depending on the angle you look at it, inflation can be seen as harmful, but at the same time, it could be viewed as beneficial. Where do you stand in all these? Do you think the rise in prices we are currently experiencing will stop? Personally, how are you coping with this worrying state of economic affairs? Has it been beneficial to you, or life is a living hell for you now? Let me know in the comments section below, and don't forget to subscribe to the channel. Until the next episode, thank you for watching. Bye.